And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
Luke Smith, good afternoon.
Good afternoon.
Did you like that?
I hate to think what you say about me when I'm not here.
Don't ask.
Exactly.
Don't ask and you won't know. Dear. No, but look, apparently the youngest member of the cricket team is 27.
Right.
That's Cameron Green.
Right.
And he's the only one that's under 30.
Well, I'll tell you how disconnected I am. For $1 million, you could say name 5 people in the entire team, and I couldn't do it.
Yeah. Oh, there's still some big names there, and Steve Smith is still going strong. He was the only batter
he'd be the
yesterday that actually made a serious dent with 70-something, I think was his score.
Because the other one that cries, he's out, isn't he?
Yes, they're all
gone.
out. The Aussies are all...
The cheat that burst into tears, he's done, isn't he?
Which one was that?
Warner.
Oh, what? No, he's long retired.
Oh, there you go.
Yeah.
So there's a positive.
He retired ages ago.
Did he? Oh, there you go.
Goodness me.
That's
Where
a win.
have you been?
Well, not in cricket.
Not in cricket. Yeah, there we go. So the purpose of our meeting today, of course, is nothing to do with cricket.
Nah.
Or even the good-looking weather outside at the moment, sunshine and blue skies. It's not
Beautiful.
bad for a winter's day.
No.
But today we're talking about the bank of mum and dad.
Yes.
And protecting your children to protect your retirement. All right, Luke, what do you mean by that?
Well, this has come up 3 or 4 times this week, so I thought it was quite prevalent because everybody be in the same boat. And I had a scenario where I'd had a discussion with some clients around funding the mortgage payments of a daughter.
Oh, yes.
And the daughter hadn't been aware enough to go and get a suitable level of personal insurance. Mm-hmm. And that then got us chatting in the office and in meetings, raising the need for parents to think about, all right, we've got kids, we all love our kids, we do anything for our kids, but do you have the means to help your kids? Now, as parents, you do it anyway, probably to your own financial detriment. And that's really what today's topic is about, is getting mums and dads out there to have those conversations when the kids come round for a barbecue on Sunday and say, hey, listen, if anything bad happened, have you just sort of sat down and got, right, I've got some income protection to secure my wages, because that's really important. And that's handy because the premium you pay for that in your own name is tax deductible, and everybody loves a tax deduction. But I put a slant on this in saying that where kids are younger, they're borrowing a lot of money to buy houses, they're committed substantially to financial instruments like a mortgage, investment properties, a couple of kids, school fees, etc., etc. A lot of younger people now don't think anything of borrowing a ton of money, but then don't go, well, let me ensure that it is suitably insured. Do I have life cover if I died to pay it out? Do I have TPD if I had an accident? Could I clear the debt and pay the kids' school fees? And this is really just about getting mums and dads to think about, well, that's my kid's problem. No, that's your problem if they're not insured because they haven't put their big girl, big boy pants on and gone and had experience and a conversation about that stuff. You then come back to mum and dad and go, oh, listen, I've hurt myself, I can't work. My mortgage is $5,000 a month. Now that's $60,000 a year. Mum and dad go, oh, okay, well, you know, we'll cover it for a bit. Now, if we think about the impact of that, say mum and dad have $1 million in their super fund earning 7%. That's $70,000 that they're living on and probably doing what they want to do and having holidays and living out their retirement. And now all of a sudden 60 of that 70 is gone. So we've got $10,000 left. Now we have to draw from capital in the super fund that we can't replenish because we've retired.
Yeah.
And that has a catastrophic effect on the long-term value of the fund, their capacity to offset inflation, and depending on how long said child is unable to service a mortgage, could be quite dire. So I want mums and dads out there not to say, hey, I need to do it, but to either have the conversation with their kids. So by doing that, they're protecting their own capital. And I'm also have a number of clients that will pay the premium for the kids. And if I say to mum and dad, listen, I'll give you a choice, $60,000 to pay his mortgage or $2,000 or $3,000 to pay his insurance because he hasn't got to a stage of life where he sees the need for it.
Yeah.
Pay the $3,000 because it's a lot cheaper. And that's a strategy that I find younger kids are very receptive to because cost of living is difficult. mortgages are high, it's a new experience for them, they've got school fees, etc., they may not have the spare funds. But mum and dad, then given a choice, can say, well, go and get some advice, get some insurance. Have the life and TPD through your super fund so you're not paying for it. Great. If mum and dad want to put some money in to cover the premium and add to super, great. If mum and dad want to pay the premium for the son or daughter's income protection, great. The son or daughter gets a tax deduction for the premium paid, which lessens the net cost of it. But the important thing is that families are having these conversations, because I've had a few instances of late where kids have had bizarre things happen through no fault of their own that then has a generational flow-on effect that we're all trying to protect.
It's a fundamental principle, isn't it? If you take out a mortgage, it's just common sense. You need to have insurance for life, total and permanent disability, and also for income protection. You just, one goes with the other. It's just.
So you've used that word common.
It should be
in conjunction.
It should
with
be
sense.
standard practice.
Yes, and for the financially literate, and for the parents that instill great values in their children, it is. But that doesn't mean it's common, and that's why I've seen a few instances over the last couple of months, and I've had 2 specific conversations this week about it. So I thought, you know what, let's just get mums and dads out there thinking about it, because yes, you might be able to retire, and yes, you can fund your kids' school fees, and yes, you can pay for your grandchildren and whatever it may be while you're working. But you need to think about the long-term impact of that on your capital base that you may or may not be able to replenish, or, heavens forbid, well, I can't retire in December. I need to keep working on because I'm paying for this for my daughter's kids or my daughter or whatever it may be. You may end up in the workforce for another 2 or 3 years that could have easily been avoided, especially with the quality of income protection and the basis of that insurance. For me, that's a must-have for anybody that is gainfully employed, because one, your ability to earn income is your greatest asset. And when you think you can insure 70% of your pre-disability income right through to age 65 if you can't work, if you sit down and do that math, the value of that policy always exceeds, well, I'll have a lump sum for life and TPD, and I'll clear my mortgage, I'll leave some money for my spouse, and I'll pay for my kids' school fees. Generally, that lump sum number is less than the total value of an income protection policy because of what is insured under that contract. So it's important that people understand what they can do. It's important that people can understand where they can do it. Now, life and TPD can be owned in a super fund. Life and TPD can be owned in your own name. So it's important that you first sit down and say, right, what do we need? And as a minimum, as you've just said, clear the mortgage, clear the fixed costs, clear the school fees. Right, there's my lump sum. You might then add on, okay, well, if I wasn't here, what does my family need to live? They need X amount of money. Right, I need an extra Y. Okay, there's your sum insured. From an income protection perspective, pretty straightforward. I earn $100,000. I want to cover 70% of that. I get a monthly benefit of $5,000 and a bit. I can choose my waiting period. Now, the longer the waiting period, the cheaper the cost. And you can have a benefit period right up to age 65. If you hold income protection, life or TPD through super, the premium is taken from your super balance, so you don't need to find it from your after-tax salary, which can be advantageous in light of all of those cost of living expenses that I measured or mentioned. But also, this is where mums and dads can step in and go, listen, I'll go your halves, or I'll pay for it. And the peace of mind of knowing that your son or daughter is insured secures your capital base that you've just spent the last 40 years building. That, for me, from a peace of mind perspective, unreal. But we live in a world where younger people now, it's okay, mum and dad will sort that out. And I say, well, have you had that conversation with mum and dad? Well, no, but it'll be okay. Because 95% of children have no understanding of their parents' financial capacity. What's in super, what's out of super, investment properties, commercial, whatever it may be. 95% of kids have no idea what mum and dad's actual financial position is. But as the person that hears them say more often than not, it's okay, mum and dad will sort that out. Right, well, let's get mum and dad on the phone. And I did it this week. Got mum and dad on the phone on speaker and said, listen, little Johnny here said you're going to cover this. I can't repeat what Dad said on the phone on the air, but let's just say he wasn't prone in the same boat as his son.
Yeah.
So be aware of it and understand what you can do, because the value of your asset base will not generate a level of income that can fund your children's mortgages and your lifestyle. And the downside of that is that the capital falls that you may not be able to recover. You've then affected the longevity of your super. You've then affected the earnings capacity of your super. And there can be unfixable damage that nobody really means to cause, because like the Tesla driver on the news this morning ploughing into the poles, who knows who caused that?
Autopilot, I would imagine.
You would hope, because those bollards were massive. But
And if you haven't seen it, go online, Google it, the videos everywhere.
It was amazing. But that's my point, is some of this can happen through no fault of anyone's behaviour. Could be just an absolute accident. And then you've got generational issues that we need to address.
Luke Smith from Envision Financial is with me in the studio today, and we're talking about protecting your children to also protect your retirement, and it all makes a lot more sense now. It's 10 to 4. We'll be back to talk some more right after this. Luke Smith from Envision Financial is with me in the studio today, and we're talking about protecting your children so that, at the same time you can protect your own retirement nest egg, because, look, if the kids go off the rails, it's often mum and dad that pick up the pieces. So,
exactly.
Luke, what are the key things people need to remember about this?
So I would say make sure your kids have adequate insurance, and if don't assume that your kids understand what adequate insurance means, or don't make the assumption that your kids understand what types of insurance they can get. Take them through the process. If they can't, well, send them in. We can fix it. And I think it's about the realisation that if you're going to retire, you are taking on inadvertently the behaviour and the lives of your children, because as parents, we do anything for our kids. That sort of goes without saying. Generally, also to your own financial detriment. So if they are suitably insured and they have been educated, then you can sleep at night knowing that if something does happen and it's bad, it's not going to affect the capital in your super, the need for you to sell an investment property, for the need for you to dispose of an asset at the wrong time. There are a range of things that can happen. Because I saw this the other day where the person came in, had $1 million mortgage, and he had a 30-year loan secured with 2 weeks of sick leave. And he went, she'll be right. No, she probably won't be. So let's maybe do something about that. And that's the context that we need to have those conversations. Don't assume that your kids understand your financial means. And if that means you sit down and have a conversation with them so that you can educate them in relation to that, I think it's very valuable to do so, because the younger generation just assume that mum and dad have got heaps of money and they can afford it and it won't affect anything, and they have no idea what retirement actually costs or the source of capital that you have to draw that money to fund retirement. So I think working through that with them is important. Sit down, have a look at their super fund, get an annual statement up. They're coming out at the moment. It's past 30 June.
Yep.
Sit down with the kids and go, right, here's your super. Right, we've got life and TPD. There's this much. What's your mortgage? It's that. Right, we need to get more of that. Now, how much of your income is covered? You've got that much. It could be this much. Right, call the fund, get a price. And if mum and dad pay for it, I'm all for it, because paying the insurance for your children is going to be far cheaper than funding the outcome of the accident that's occurred, whether it's financial or medical. Because servicing a mortgage these days, when you think the average mortgage is what, $850?
Something like that.
So you're talking $5,000 a month over $5,000 a year of premium. I know which one I would take. So this is really just the awareness piece to say, have this conversation with your kids, understand where your kids are at, because it's the flavour of the month to have 9 investment properties, whether you need them or not. So there could be a significant amount of liability out there. 3 little kids that you could catch from an education standpoint for school fees, and no means to be able to live and retire. So have these conversations at home, and I think when everybody's on the same page, it's great stuff.
Fantastic. We've reached that time when I must ask you the most important question. Where can listeners get more information?
Yeah, so office number 62604749. We've got envisionfinancial.com.au on the internet. We've got the podcast, the Strategy Stacker Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube, and we've got Smart Money Strategy, your ultimate guide to financial planning, that has an entire chapter on different types of insurances, why you have it, how you hold it, and how you price it. So check it out.
Beautiful. Available in bookstores everywhere or online.
Beautiful.
Absolutely. There we go. I think we've just about done it today. Luke, thanks very much for coming in.
Mate, we'll see you next week.
We'll catch you again next Friday afternoon. Luke Smith from Envision Financial back with us again next Friday afternoon at the same time, straight after the 4:30 news update.